webinar, and thank you for really joining us on this third part of the advanced planning webinar series. Now here at FB, we all know that the #1 challenge for a lot of the agents that we work with are really finding leads or finding ways of getting in front of people. It's very common for us here at Financial Brokerage to get the question, do we have leads? And we all know that that's a very difficult thing, and we have leads and we have sources, resources for you to use, but we all know that if you work leads, it's a real tough road to hoe, and it's hard to cultivate that. And we all try to deliver at FB. What we do is we deliver the great content that, first of all, doesn't waste your time and that you can immediately put into practice to create selling opportunities, or at least to create conversations that wouldn't have happened otherwise. Talking to your clients about in-service non-hardship withdrawals most certainly would accomplish that and resolve that issue. Now, we may have all heard of hardship withdrawals. That's where, that's been around forever. The IRS defines that as an immediate and heavy financial need for the employee, and the amount must be necessary to satisfy that need. Well, in-service non-hardship withdrawals really aren't required to have any of those triggers like that, where it's a hardship. Going on the next screen, you'll see here that really, as I look at things and with people inside of their 401k plans, the market continues to change. When I looked at yesterday, I think it was, the Dow Jones is at 18,000 points, S&P 500 is at 2,000 points, 2,100 or so is what last time I checked. And of course, with the market continuing to change, clients are looking for alternatives for their money. They might want to enjoy that flexibility, control, protect their principal, and what I'm going to show you at the end here is to create a guaranteed retirement income that, as you look at 401k plans or these defined contribution plans, none of those really have that securing their income or lifetime income. You pretty much have a balance in your 401k plan, and that's pretty much all you have. And you have to kind of, as you turn 65 and 70 years old, you kind of have to figure out how long is this pool of money going to last. Well, the way to do that would be to transfer the majority of that out and into an IRA. And what plans allow this? Profit sharing plans, 401k plans, stock bonus plans, employee stock ownership plans, and then also your defined benefit plans, your cash balance forms plans, target benefits, and then money purchase plans may permit them to for their employees who have reached a plan's normal to retirement age. Now, as I get into this a little bit, you'll see here that there's a kind of the underlying thing is really the plan document within the employer. So the employees aren't generally going to know if they can do that, and I'll get to the slide here where it talks about that. But the plan assets are available for withdrawals, after-tax contributions, rollover amounts, company match contributions, and all of that, of course, is plus the earnings there. Before-tax contributions are allowed if you're disabled or have reached age of 59.5. Now, the IRS says that the employer can't go longer than 62 years old, so you got to have it. You got to have it available if you choose to make it available. The IRS doesn't say that you have to make it available, but if you are going to make it available, you got to provide it less than 62 years old. And most employers that I've found are 59.5. They follow that 59.5 rule. Although there's some of them out there actually are younger than that. Allow it for younger employees. And at the bottom there, it's just that little disclosure. You can read that, of course, but it really is based on the plan document. And as I said, the employer doesn't exactly make that public. They don't, when you're at those annual meetings in the 401k plans, they don't exactly make that public. I don't think they're trying to hide it from you, but it's just something they choose not to announce in most cases that I've seen. And then who may be eligible? Again, this goes over I'm not going to read this whole thing. There's a lot of stuff in there. But it really has to do with the plan document. And a lot of the ones that I've seen, plan guidelines include a minimum age restriction, usually 59.5, and then you also have to have a number of years, often 2 to 5 years of continuous employment. And then, of course, the employee responsible retirement plans often limit these withdrawals to, as I said before in a previous slide, all the matching contributions before tax and after tax, and it does go over that. At the very end of that statement there, where some of the states, and these are going to be your community property states, they will require, in some of the plans, not all of the plans, require you to have that spousal consent for that in-service withdrawals. Now, is it worth the hassle? I don't, I would say it would be. It does say here that never been a better time to do this. Your client gets to lock in their gains, and that the next slide I'm going to show you here will say that. If you consider those pre-retirees that had 401k plans in 2008 when the market crashed and they lost a whole bunch of their money up to 50%, I would think that they would have liked to have that opportunity to at least roll their money or at least look at it to lock in those gains and to not lose that money, which is what you can do. On the next slide, you'll see here a case study, and this just pretty much talks about an individual. The guy's name's Ed. Happens to be in a 401k plan. He's an executive of his 401k plan of the company that he works at, and due to fluctuations in the plan balances in the past, he wants to lock in that gain and really secure an income. And as I said before in that first couple of slides here, that once you have a 401k plan, you have a pool of money. It doesn't necessarily say that your pool of money is going to last till age 99 or 98. You don't know that. ING did a great job in their advertising. I think it was 3 or 4 or 5 years ago, where you probably saw those commercials with those individuals out there in a park or whatever carrying this number. It was like 1.3 million or 1.2. It was very an odd amount of money, but I think that was brilliant. But so your 401k plans don't give you that. They just give you a pool of money, and you have no idea how long it's going to last. So that was Ed's concern. He wanted to protect his gains from previous years, as well as the ability to plan on knowing exactly how much income he would have to retire on. And that's accomplished with one of our indexed annuities that we have here at Financial Brokerage. Many indexed annuities have income riders on that, and that's really what I'm going to show you on this next slide, where he elected to take $250,000 out of his 401k plan. He's planning on, again, he's 50 years old. He's planning on starting his income when he turns 65 years old. And you'll see here that with the bonus that he gets on the indexed annuity, as well as the income rider on there, that guarantees him a particular amount. Now, of course, this shows him starting at the age of 65, and he's able to take out nearly $36,000 a year. His income pool then rose to nearly over $700,000 in his pool of money that he can take income from. And like I said before, that's nearly $36,000. Now, I don't know about you, but I think that's a great way to at least secure part of that. And I'm not saying to do all of that 401k plan, but if you had a good pool of money in there, put $250 in there, and then of course that's going to guarantee that amount of money. And I really wanted to keep this very, very short. We've had some of these things run a little longer, then we don't want to certainly waste a lot of your time, so we wanted to keep this very, very brief. So it's probably going to be under 15 minutes, under 20 minutes without any questions. And then what to do now? You're maybe thinking about this, and as I said before in that first slide, you run out of things. Some of the agents that I work with run out of topics to talk about with their clients, and now is another way to actually go back to your client and ask them this. And if you were to ask the average client, like I said before, they're not going to know that. And the way to do that is for them to check with their employer. Now, I've actually done this before, where I've called the employer myself. I mean, it's public information. It's not that I'm getting a Social Security number or anything like that. I could just say I'm David Corwin. I'm an advisor for one of your employees. I just wanted to find out if your 401k plan allows in-service non-hardship withdrawals. And they may have to check a little bit. You might be on the phone for a couple of 3 or 4 or 5 minutes, but you'll find out really quickly if they do. And so the next step, I think, for the agents that are listening to this, that have joined us on this webinar, would be to contact any and all of your clients, and because people really, like I said before, have no idea that they can do this. And I think it's a great topic. It's been around since the Pension Protection Act in 2006. And as I said, it's one of those topics that doesn't get talked about a lot. That's why I wanted to bring it up. And then have them contact their prospective employees. Most plans, like I said before, allow it, but they don't exactly advertise it. You just have to ask. And and I actually have a little bit of a surprise on this too, is I was able to obtain a list of all the employers out there in the marketplace that allow this for their employees. I will send this to you, anybody that asks for it. So, I'm just looking at it. It's a list of 190 or so employers on here, and just the ones that come to mind, Anheuser-Busch, are the ones that come to that I can see out here. I mean, there's 3Com, AAA, and some of the more, I guess, advertising ones out there. But AT&T, Anheuser-Busch, Boeing, Black & Decker, Home Depot, Bank of America, Caterpillar, Cisco, Coca-Cola. I'm not going to read all of these off, but you get what I'm talking about here. This would be a way. I mean, you're going to Lowe's, and you talk to a manager there. Guess what? He can do it. All you have to do is start a little relationship or a little bit of conversation with him about, would you like to secure your gains? And that would be a way to do that. So I'm gonna actually stop here and see if there's any questions that have come up with any of the folks on there. As a matter of fact, I'm going to unmute a few of them and open the lines up and see if there's any questions that might come up. Dave, do you have anything to add on this?
No, I think you did a great job, David. This is something I personally have done a few years back, and I've been extremely satisfied with the results of it. And I think when you're talking financial and retirement planning with your clients, that it's a good idea to consider diversifying those assets, and that would include not only within the 401k plan that they have, but taking a percentage, perhaps 10 or 15, 20%, or whatever they feel most comfortable with, and transferring it into an index annuity that does secure their principal balance. It gives them a guaranteed increase in the lifetime income benefit pool, and will help them at least have a portion of their retirement income guaranteed for the remainder of their life. So I personally think this is a great idea as well.
Yeah, I do too. So thanks a lot. Appreciate it. Let's see if there's any questions that have been out there. Just a couple of things I do want to mention to you too is we'll be doing this very same thing. And Dave, do you happen to remember what the topic is in a couple of weeks that you'll be talking about?
I don't recall offhand. It might be, I believe it's Key Person Insurance Plan.
Okay, Key Man Insurance. Yeah. So the next couple of weeks, same time, same bat time, same bat channel. We'll be doing this exact same thing. We'll be talking about Key Man Insurance. A couple of weeks from now, you'll be hearing us again. And then next week, Brian's going to be delivering the Linked Benefits 202, 5 advanced concepts on linked benefits planning. That's going to be next Wednesday at 10 o'clock. Pretty much all the webinars are done at 10 a.m. as Central Time, about every Wednesday. That's what we try to do that as well. So if there's no other questions, I tell you what I will do, though, is I'll reach out to all the attendees on here and see if there's any other questions, because I know on webinars, I've been on hundreds of them, and sometimes you don't want to ask questions, and you may be thinking of questions, and you may not want to ask them because you may think it's a dumb question or whatever. So that's what I'll do. I'll also reach out to all of you and see if there's any questions about that, because it's really, like I said before, it's ultimately about that plan document that the employer has, and it requires a little legwork. That's, I think, why people don't oftentimes do it, is because it does require other parties involved, and sometimes it's hard to ask those hard questions because the employee, again, may not know that answer and all that. But with that being said, I'm going to go ahead and end it here. And if there's any other questions, feel free to reach out to any of us here at Financial Brokerage. Our number is always 800-397-9999. And my extension there is 3132. If you have any questions, feel free to give me a call. And I appreciate you joining us on this call. Thanks so much. Bye-bye.